Since the financial crisis ended, the bond market has been on a tear. But the days of great fixed income returns could be a thing of the past. A growing chorus of bond experts is sounding the alarm that bonds are a riskier investment than in years past. While we heard warning bells rung at the start of 2012, the average taxable bond fund returned a strong 8.2% for the year, according to Morningstar. Over the past 3 years, investors globally have poured nearly $700 billion into bond funds, pushing yields to record lows as prices have soared. But as we enter 2013, have prices finally reached their zenith? And are investors taking on more risk in bonds than they bargained for? Joining me now to share her outlook for the bond market is Jennifer Vail, head of fixed income for U.S. Bank Wealth Management. Jennifer, welcome to the program.
Thank you, Jennifer. Very glad to be here.
I love your name. We're name twins.
Yes, we are.
So there's a sense out there that the bull market in bonds is getting a bit long in the tooth. The calls are new. However, are the risks for investing in bonds now greater than they have been at any time in the last few years?
Well, we do not see any evidence of a credit bubble at this time. Now, that said, we are seeing some early signs of a mature credit cycle. Things such as the robust issuance of high-yield debt. The increased interest in what we call creative financing deals, such as PIK loans, payment-in-kind deals, and the sheer volume of interest in the lower quality names. This is usually writing on the wall for an increase in default rates as early as 2 years out. Now, what's going to continue to support the credit markets is the positive impact of the prudent balance sheet management. You've seen domestic corporations refinance a lot of their debt in this existing interest rate, this low yield environment. So that has actually reduced their interest expense. In addition, you've seen them build up cash on their balance sheets. So both of which are a positive in delaying that spike in default rates.
Right, you said that you don't think we're in a credit bubble right now, but I guess my question is, how much higher can bond prices go from here? Because the math would suggest there's not that much upside with yields at record lows.
I think at current levels, the market is telling you that future appreciation in bond prices is likely to be limited.
So then how does the Fed's pledge to purchase $85 billion per month of mortgage-backed securities and treasuries until the labor market improves, how does that factor into your outlook for bonds? In some way, I feel like I'm talking out of both sides of my mouth, but will that continue to put a floor under bond prices?
It is creating somewhat of a backstop because he's committed to keeping the rates low.
Right.
Now what this does is what the Fed's essentially saying is that he wants investors to buy higher risk assets to help boost the economy. So he's intentionally keeping those rates low to move those investors out into those out that risk spectrum. The need for income and yield is still just as strong as it was 5 years ago, 10 years ago. However, yield and income are in scarce supply right now. So that drives further investors into these credit sectors, supporting that market. And then the Fed in there on top of that, keeping the cap on how high yields can go, are protecting those investors at this time.
We've seen the 10-year Treasury sell off in the early days of the year as investors have flocked to riskier investments, and as investors have also worried that the Fed might actually end its bond buying program earlier than thought. Is this something you expect will continue as the year wears on? What's your outlook for the 10-year in 2013?
Our views going into 2013 is that risk aversion will likely show its head again during the debt ceiling, budget, and sequester negotiations. The result of those negotiations will be a modest spending cuts. So we would expect by spring to see the financial risks recede and possibly some of the deflationary threats to lessen. This is going to generate modest incremental yield pickup as we move out the curve, causing a slight steepening in the curve. So we would expect the 10-year Treasury to end 2013 at just under 2%.
So basically flat, because that's where we are right now.
Yeah, that's about 15 basis points above where we are now. So you have that pressure of the Fed committed to keeping those rates low, and then you have that increased interest in the Treasury market via institutions due to Basel regulations. So both those items are putting a cap on how high yields can go.
So Jennifer, where should investors look within the bond complex for 2013? Where are valuations relatively better in certain areas than others?
So in the domestic market, municipal bonds should retain their value fairly well this year, given the result of the fiscal cliff negotiations has caused some additional interest in municipal bonds via the tax increases on the wealthiest. And then also you have a reduction in issuance in municipal bonds, which should also provide some support for the municipal bond market. But frankly, the largest opportunity in the fixed income space is likely not domestic. Specifically, we prefer the emerging debt managers for multiple reasons. The budget and current account, the emerging market does not experience the budget and current account deficits plaguing the developed world. In addition, you see an incline in credit quality in the emerging market space, whereas you've seen a decline in credit quality in the developed space. Inflation in emerging market countries remains contained, smoothing that path to additional easing by policymakers. And then lastly, as we expect an improving global economy, that generally results in a dollar decline. And dollar declines traditionally will create opportunities for emerging debt manager outperformance.
Jennifer, what about high yield? As you said earlier, as you referenced earlier, I'm wondering if the lily is off the vine there. I know that corporate America has really been working to shore up their balance sheets, and for the most part, they are pretty robust. But it's because there's been so much demand for corporate bonds. Do you think that there is greater risk, perhaps, in the high yield sector than there has been maybe in the past couple of years?
Absolutely, if you look at default rates and where they're at, 'cause you can't just look at spread levels or yield levels. You have to look at yields relative to U.S. high-grade yields. And currently, high yield is about 209% of investment grade yield. Now, the 10-year average is 183. So high yield is still paying proportionately more yield than it has in the past above investment grade. In addition, we look at spread levels, and we look at spread levels in this default rate environment. And spread levels tell us that the current move in high yield is a bit overdone, and that we would expect that to ratchet itself back a bit. If this does not occur before mid-February, we would expect the risk-off trade to be fully in place by mid-February, and that also will cause some decline in the prices of high-yield bonds. At current levels, high yield does appear expensive.
Jennifer, I know that you're a fixed income expert, but are there actually more opportunities, better opportunities in stocks than bonds now?
We feel that there are certainly greater opportunities in equities than fixed income at this moment. If you look at PE ratios, if you look at the potential for growth post the debt ceiling sequester and budget negotiations, and also if you look at where the 10-year yield is relative to where the dividend yield is on the S&P, they're inverted, which doesn't happen very often. You're getting more yield buying a U.S. equity than you are the 10-year Treasury. So U.S. Bank most certainly has an overweight in equities and an underweight in fixed income at this point for 2013.
Jennifer, thanks so much for being with us. I hope to see you soon.
Thank you very much.
Jennifer Vail, Head of Fixed Income for U.S. Bank Wealth Management.